following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
All right, it's good to hear that music again. Long-time listeners will know we've been on a bit of a hiatus for the past few months with a few sporadic live shows here or there, but now we're finally back in full swing, and it feels very, very good to be back. Welcome to Volatility Views, your weekly source for all things volatility. My name is Mark Longo from the OptionsInsider.com, as well as the old Options Insider Radio Network. And there's been a gaping hole in my life over the past few months, listeners, and I'm sure there's been a gaping hole in yours as well, and that is I haven't had the chance to listen to the melodious tones of my cohort here, my partner in crime, good old Don Schlesinger from the Volatility Exchange. Don, welcome back to the show. It's been too long.
Well, that's certainly true. The NFL and Volatility Views all back in the same weekend. What more could anybody want?
You know, I always knew there was some secret correlation between football and volatility, and now finally I've discovered what that is. So there we go.
The cup runneth over for our listeners, huh?
And because this is our first show back, we decided to do something a little bit extra special and have a special guest join us for the entire show. He is Dan Passarelli, the major domo over there at Market Taker Mentoring. Dan, welcome to the program.
Oh, Mark and Don, it is great to be here. Thanks very much for having me.
And, you know, we usually will reserve the intros for the Volatility Viewpoint segment, but since you're going to be joining us for the whole show, why don't we get into that now? Now, some of our keen-eared listeners here on the Options Insider Radio Network will recognize Dan's voice. He is my co-host from our Options Bootcamp show, which also returned this week, so it's been a big week for the network this week. But Dan, for those listeners out there in Volatility Views land who may not have tuned into Options Bootcamp, why don't you give them a quick rundown of your background in the options biz and what you do over at Market Taker Mentoring?
Sure, man. I've been in this business, I guess, a really long time, almost 2 decades. Holy moly. And have the gray hair to prove it. But, yeah, so I started down on the trading floor in 1993 as a runner and became a trader, traded for a long time as a market maker down on the CBOE floor, and traded for a bit on the Board of Trade trading floor as well. And now I do a lot of teaching and writing. I wrote a couple books on options, and I teach individuals how to trade options via my company, markettaker.com. So if you're learning options, which I bet most of the listeners here are interested in that to some degree, take a look at markettaker.com and see how we might be able to help.
I like to tease Dan that he is the man that literally wrote the book on the Greeks. What is the title of that book again? Is it Trading Options Greeks, or what? I'm close. I'm in there somewhere, I know.
Yeah, you're very close. It's Trading Option, singular, Greeks. Trading Option Greeks.
Oh, okay.
And it is available on Amazon. That's where I just kind of direct everybody. So take a look at it. It's
if
a good
you're
one.
Interested in the Greeks, and I know some of our listeners, judging from the questions we have today, are very interested in the Greeks, and by all means, surf on over to Amazon and pick up Dan's book. It's a scintillating read, particularly if you're into those Greeks. But with the panel assembled for today, we're going to dive right into our volatility review.
It's time for the Volatility Review.
All right, and welcome to the Volatility Review. And it feels so long, Don, since we've done this. It actually has only been a few weeks since our last live show, but since we actually have been doing the show on a regular basis, it has been quite a while. So I'm very rusty. So forgive me if I err in a segment or two here or there, and perhaps put the crystal ball first or something crazy like that. But, of course, this is the Volatility Review segment. This is, of course, where we run down what's typically the week's worth of action from a volatility perspective. But because we have been off for so long, it's been many weeks, we actually have a much longer purview to look back upon. And actually, Don, the last show we did was with Bob, so you actually haven't been on in a while. So you even have a longer purview to go back, if you like, and look back at the land of NASDAQ, because, of course, we all know NASDAQ is your baby over there at Volex these days, and that's definitely where a lot of your attention has been focused of late. So let's start there. What have you really been watching in the land of NASDAQ volatility since the last time you were on the show, which has been several months now, Don?
Well, of course, I'll try to touch upon NASDAQ and a little bit of the S&P as well. And I think I've got a couple of really interesting observations to make. But bottom line is that since I actually did one of our shows in July around expiration time, and then Bob filled in for the August show, if I were to take the longer term view and go back to July, you really just have what amounts to practically one-way activity, yesterday that we'll talk about in a moment. But when I left our listeners in the middle of the summer, NASDAQ volatility was up in the low 20s. We're talking about realized volatility, actual market volatility. I suspect that implieds were even higher still, and they have just marched steadily downward to actually historically low levels, below 10, once again, before yesterday's very big movement. So similar patterns and charts for the S&P, and really, what seems to be seasonally true from year to year, that over the summertime, with decreasing volume and lots of people away on vacation and awaiting the return after Labor Day, we get this decrease both in implied and historical volatility. And some of those numbers that I referred to, believe it or not, earlier in the week, the S&P 21-day historical volatility. So this is close to close realized volatility of the S&P hit 5.98. And those are levels that have not been seen for more than 5 years.
It's amazing.
People probably don't realize that because, and I want to comment on this, looking at VIX as only 2 or 3 days ago, it was up in the high 18s. And people see those numbers and they use it as a surrogate for volatility without perhaps understanding, in this case, what a disconnect there was and how historical volatility was at this extreme level. The NASDAQ number was 815, 8.15, historical 21-day, 1-month volatility on the NASDAQ as of a couple of days ago. So this is really quite extraordinary. And what we saw was that when VIX was up in the mid to high 18s and realized was basically, let's call it 5.98, this is the S&P, you had a spread there, implied minus realized, of 12 points, which is very, very, very stretched. As our listeners probably know, we've referred to the typical spread long-term average of 3 to 4 percentage points of a risk premium of implied over realized. And here you were looking at a spread of 12. And I'm sorry we didn't do the show a couple of days earlier because, Mark, you're always talking about that extra little island that we might be able to buy for some of our listeners with a recommendation. So you'll just have to take my word for it that when I saw this kind of a stretch in the spread, my immediate thought was, there's only one way to play this, and that is that this is going to shrink. And it certainly didn't take too long. And believe it or not, with yesterday's activity, the S&P 21-day is all the way back to 904. So you had an incredible 50% increase in 21-day historical volatility just due to yesterday's action. And of course, we've mentioned this so many times in the past, but it's a new season, so we may as well mention it again. When we used to have our meetings explaining Volex and Vol contracts to people, one of the things they would say was, gee, you're logging the daily volatilities and, they accumulate over a 1 month or a 3 month period. So it must be that when you get down towards the expiration, you really would have no interest in owning such a contract because most of its value is determined already. And I say things like, well, you know what? Let me tell you a story. And the kind of story that I tell them is exactly what happened yesterday. We were sitting on 21-day volatility of ostensibly 6 for the S&P, and yesterday's 2% movement in the S&P, which would annualize to like 32% volatility rather than the 6 that we had, that one single day brought the 21-day historical from 6 to 9. So with one single day at the end of the 21 days, the value of what would have been a vol contract or a realized volatility contract increased 50% when the index was up 2% yesterday.
That's insane. We have a listener writing in, we'll get to it a little bit later, asking about the gamma of Vega, and there you go. There it is right there.
So, there you go with that. And then the final point that I will make is simply that spread that was 12 points with VIX all the way down as we speak now to about 14.5 or 14.6, and the S&P at 9, we're right back to traditional levels of 5.5 points of that spread. So when you see these kinds of distortions, you really have to not hesitate and jump on them because it doesn't take too long for them to snap back to historical levels.
The refrain everywhere these days has been vol is cheap, you don't want to sell it here. And I've even been starting to fall into that realm a little bit myself of late just because these levels are getting so astronomically low. But you're right, when you look at it from to compare that, like we talk about all the time on the show, the realized versus implied premium, that premium is still there and it's still sufficient, or I should say substantial, really. It might take a little bit more in the way of intestinal fortitude to chase it down when the vol is at these levels, and maybe you want to put a few kickers on the back end in case the worst does come to pass. But it is still a very viable trade, and we've seen it every weekend. Every weekend during the week, there certainly has been no reluctance on the part of the institutional vol traders out there to continue blasting away, hitting bids on S&P downside or whatever the case may be. They don't want to hold this vol when these premiums and this implied versus realized premium is still so substantial. And I think a lot of people have been starting to say, wow, this is getting a little bit extreme, but the premium is still there. So there still is a viable trade as long as you do it, I think, in a little bit more circumspect and cautious fashion than you would perhaps when the VIX is at 35.
And I'm interested in Dan's point of view later when he speaks about his clients and the type of trades that they do with options and how they will be using not only existing instruments like VIX futures, but hopefully our realized volatility vol contracts when they're made available. This is the thing that's so fascinating for us. Trades such as this one, again, we've said it all along, we're not looking to replace VIX, but simply to become an alternative because they're going going to be spread opportunities such as the one that I just mentioned, where people are surely going to want to play off realized against implied and do this kind of trading. So we hope that, rather than be a competitive type of thing, that they really will almost have a kind of symbiotic relationship where one will play off the other, and there's plenty of room for both of them to thrive.
Oh yeah, that's got to be inevitable. I mean, when it comes to arbitrage opportunities, you build it, they will come. I mean, it's a great way to just isolate volatility and trade it in a very, very pure way.
And speaking of that premium, we're looking right now, and we're recording this at our usual time around mid-session here on Friday, and we're talking about the premiums we're seeing in the S&P and the VIX and in the NASDAQ. VIX cash is down a bit today, but still trading well over 14.5, 14.64 right now. And the VIX NASDAQ, which is, of course, not really a tradable product, but gives you an idea of what's going on from an applied perspective out there in the NASDAQ options, is 16.5 right now. So you can see that there still is a substantial implied premium right there in the marketplace. Of course, with all that's going on in the macro world, perhaps that's not exactly too surprising, but if you're a hardy soul, then you can certainly still capture some of that implied versus realized spectrum. All right, I think that's a good jumping off point there, Don, too, because I too want to get into what Dan's students are up to and how he approaches volatility in this type of environment. So why don't we do that then? Why don't we close out our volatility review and dive right into our Volatility Viewpoint segment?
Now it's time to discuss volatility and volatility trading strategies on Volatility Viewpoint.
All right, and that funky, almost island tune means it's time once again for our Vol Viewpoint segment, where we bring on a guest, and today's guest is good old Dan Passarelli. And I think Don brought up a good point of entry for the conversation here. And that is, Dan, as you're bringing in a lot of new clients, and I'm sure you have a lot of people coming to market taker mentoring these days, whether they're beginner, intermediate, or advanced, and they're looking to talk to you about volatility. And I'm sure a lot of them who come to you lean towards the premium selling side of the fence, as do most of the listeners on this show, and as does Don. I'm not sure if you're familiar with Don's sell or don't sell methodology, but that's his trading methodology in a nutshell. Sell or don't sell. But I'm sure a lot of your clients are coming to you with that same type of methodology. They want to learn about selling premium, collecting income, generating income and dividends in this environment. So how do you counsel those people who come to you in this environment? Are you teaching them to be more cautious and indeed cognizant of the volatility levels at which they're trading? Because that's something we've seen historically in the past, particularly with retail, that they just come in and they will blast out any premium they can get. They don't care, or they don't really know of the vega that they're selling. They don't know the vol levels they're selling. Oh, it's 35 cents. That's a good trade. I'll sell it. And there isn't really much beyond that. So are you starting to walk your clients through the extra levels of nuance that go into trading volatility?
Yeah, you know what? I start out even the beginners on volatility. And, I don't try and get too fancy about it with them. Just give them the basics. Just, hey, look, okay, maybe you want to trade simple equities. You want to put on some plays in Apple. You want to put on some plays in, wherever, GE, Citigroup, whatever. Step one, okay, look at the stock chart, look at direction. Step two, flip through the news, make sure you know when earnings are. And step three, the final step, not too many steps, but a really important one is pull up the vol chart. Take a look at it on every single trade. Hey, you know what? You're just taking a momentum buy a call play. Great. Direction, look at the news, look at volatility. Because you know what? You can take a directional play in a number of different ways. You can go out there and buy a call, which is kind of the go-to strategy for the basic people. But you know what? If volatility is way overpriced, you're just putting yourself at a statistical disadvantage. Of the three things that you can have working either for or against you, direction, time, and volatility, you got to get these things working in your favor. And buying expensive anything is not a particularly brilliant idea if you're trying to make money.
Dan, reminds me of the old Woody Hayes. I don't know if this dates me, and going back to the Ohio State days when, 3 yards in a cloud of dust and never want to throw the football, because he said when you throw the football, there are 3 things that can happen, and 2 of them are bad.
Yeah, that's about it, man.
I'm sure that's probably where a lot of your conversations start. People come to you and they want to do the cliche retail trade of I want to buy a bunch of upside calls here in this name. So hopefully that's where the conversation starts, is you migrate them to perhaps a more rational trade away from the lottery tickets. And then you get into all the and I'm sure that conversation can also segue into why that's a bad trade from a volatility perspective, and other things like that. But we see time and again so many people diving into the options market, and that's their first point of entree, buying a ridiculous amount of upside calls in whatever name they're trading. A lot of them happen to be Apple these days, but it could be whatever floats your boat. And it's nice to have some guys like you out there who are doing the heavy lifting. We can do so much on a website like ours, but we can't sit down with the person and actually smack them in the head and say, wait a minute, why are you doing that? So you guys who do all the in-person mentoring at least can work them through that in a little bit greater detail.
Yes, but we're not allowed to smack them in the head either. This is not a Catholic school.
Do you frown on smacking in the head at Market Taker Mentoring? Now, but let's hit on that some more, because that is, like I said, that is the purview of this show, volatility, and I think it's a very fruitful topic for a lot of your clients these days and a lot of our listeners. So let's say, maybe let's talk about it this way then. Do you have a lot of people coming to you in this environment when volatility and things like VIX are very much in the news cycle these days? Or a lot of these, even the very unsophisticated options clients, are they coming to you and saying, hey, I want to trade vol, I want to trade VIX, and they want to dive into products that are perhaps a little bit over their heads, like something like a VIX option, which is, a derivative of a derivative essentially, and requires a lot of explanation before you really know how it works? And do you kind of coax them back from the ledge a little bit and say, okay, maybe we'll start with a simple vertical and kind of go from there before we jump into things like VIX options and futures and all that other fun stuff?
Well, yeah, some of these guys, they say, oh, yeah, I want to trade volatility. That's where the real money is. I say, hey, you know what? You're actually trading volatility. Whether you know it or not, every option position you put on is a volatility trade. It's got a vega. And it's got sensitivity to the underlying moving, so thus it has sensitivity to historical volatility. You are trading volatility, whether you know it, whether you like it, whether you want to or not. You're trading volatility. But then when, one of the big mistakes too is that people who are brand new say, oh, yeah, the VIX, yeah, that's volatility. I'm going to start trading that. And they don't take the time to look into the product. Maybe they understand volatility, but they don't understand how VIX works. And they end up getting it handed to them. I tell people, hey, you know what the easiest way to make $1 million trading the VIX is? Start with $2 million. If you don't understand it, that's how it works, right? So I teach people who are interested in trading the VIX, step one, look, this is how the product functions. This is how it works. It doesn't work like you think it is probably. It doesn't work how you think it does probably. So let's get that down first. And then now we can roll up our sleeves and really get down to the heart of the matter and really trade it.
Do you ever take some of those clients who are coming into you looking to trade vol, and maybe in the scenario we just discussed, where there's a significant implied premium versus realized volatility? Do you ever get that granular with them, or do they maybe get that granular with you? Maybe they're that aware. Maybe they're a higher end client and they say, hey, I want to try to capture this implied versus realized premium. How do I go about that? Do you ever walk your clients through those types of trades?
Yes. All the time. Yes, absolutely. All the time with just standard implied volatility versus historical volatility on equities. And then sometimes with the structured products, with the stuff like the VIX and VXX and that kind of thing. And boy, it's going to be really exciting once the new vol products that you guys are working on, Don, come out to where, then they're really going to have it.
Yeah, we really hope that we're going to hit the ground running with a full suite of products. They may come out serially rather than all together, but the vision, of course, is for vol contract futures on realized volatility and options on those futures, and then ETPs to be able to offer, the full array to have as wide appeal as possible to all segments of the market.
Yeah, because like I alluded to before, I mean, that's a pure volatility play. I mean, when some of my more advanced students say, "Oh, hey, look at this in Apple right now, the implied volatility is this, versus the historical volatility is this," or I guess maybe more practically, hey, in the NASDAQ or whatever, hey, look, the historical volatility is this, the implied volatility is this. How do I do this? I mean, I want to sell a straddle, should I be doing that? Really, all I want to do is play the volatility, but I end up with all this other stuff, this time decay and all that business. If that's what you want to do, you just want to play implied versus realized, now when we have those products available to you, now you can do it in a very, very pure way, and that is something special. That's for the people out there who really got it going on and are really looking to take advantage of this without all the noise that comes along with traditional options.
Well, that's a very, very good point, and it's certainly a valid one. For the longest time, we would always joke about, how do I trade volatility before the advent of all the products. And, I used to say in my seminars, you really can't. You really can't call up an exchange and say, "I'd like to buy some volatility, please." This was before swaps or anything at all. I said, what you have to do is, either buy options, calls, puts, put on a straddle, and then pray for volatility. And you have to manage the position with all the other stuff, the aggravation of the path that it takes and time decay and the other things that come with it. So I was actually going to ask you that question as you brought it up. And the question was, you mentioned that every time you trade an option, you're really involved one way or another with volatility, because the sensitivity of the option to changes in implied or realized volatility is an integral part of managing any position. But then again, there are the pure plays, or as close to pure as possible, that we really deem as volatility plays, such as buying and selling straddles or strangles or back spreads that are designed specifically to make money if your viewpoint of volatility is correct. And I was just curious as to what percentage of your clients and retail traders in general and the people that you deal with are interested in those kinds of spreads and positions as opposed to perhaps the more simplistic ones.
Well, it's kind of a funnel as far as what that picture looks like. I mean, when people first start out, they just heard about options. Oh, they're leverage. Okay, I want to buy calls, and that's a whole bunch of people. And then as people get more advanced, there's fewer of them, So I don't know. I bet there's a good somewhere between 15 and 25% of my students who are able to, they're at the point where they're intellectually able to make those trades, and they register enough on their radar where they do have that interest. So, it's a pretty good percent, probably a higher percentage than a lot of people would imagine out there.
Good to know.
Don, you can tell you and I have been doing this show together for a while, because I was just about to dive into the same question. So we're on similar wavelengths, you and I. But
you know the old saying, great minds think alike.
But because we talked a lot on this show in the past, Dan, particularly in our very early episodes, about different ways to trade the quote unquote pure volatility. You have the straddle example that Don just brought up. You have the delta neutral, which is the way you and I and all the guys on the floor were trained back in the day. So when you're looking to take those pure quote unquote, I have to always put it in quotes, those pure vol trades with your clients, what's your MO of choice? Are you a straddle man? Do you go down that dark and dangerous road of delta neutral with gamma scalping and all the inherent complexities that go along with that? Or what is your methodology over there at Market Taker Mentoring?
Yeah, I've had a good handful of students who wanted to learn gamma scalping. I had a guy in Sweden not so long ago. I've had a few guys who wanted to learn gamma scalping, and I showed them. And, gamma scalping, for those of you out there who aren't really familiar with this kind of stuff, it's delta neutral trading, but specifically it's long volatility biased. You buy basically a straddle, or a synthetic straddle. And when the stock goes up, you get long deltas, so you sell the underlying. And when the stock goes down, you get short delta, so you buy the underlying. And if the stock just oscillates back and forth, as long as you can scalp enough to cover your time decay, you're making money. And then, of course, on the flip side of that is if volatility is expensive, you don't want to own it, so you want to sell it. And back when Mark and I were market makers, we would effectively have synthetic straddles. I mean, you'd look at the position and it wouldn't look like a straddle to many of you, but for all intents and purposes, at each strike, we're either long the straddle synthetically or short the straddle synthetically. And, telling a retail customer that they ought to go out there and short a straddle, I don't know, man. I kind of check swing a little bit on that.
Yeah, that's a hard sell, I think. I think also a difficult thing to wrap their heads around, and also you don't want to push them off that cliff, certainly if they're not ready.
Yeah, so you know what I do? I mean, here's for the advanced retail trader who intellectually has the experience level that they can understand gamma scalping and do it, and B, they're well capitalized enough, and C, they have retail portfolio margining. You have those three things and you can do it. My students who are in that category and express the interest, I show them how to gamma scalp from a long volatility standpoint, but from the short volatility standpoint, you know what I do? I just go into just the plain old traditional income trades. I mean, a butterfly with really, really wide wings is a short straddle with a cheap insurance policy. And, I just teach them.
Or as I like to point out, a short straddle for cowards.
Yeah. Yes. Yeah.
I like that. That might have to be the title of our episode.
That's up a good thing, buying those outside.
I think we have a title there, Don. I like that. That's a good one.
Dan, I'm not going to disagree with you, because as you pointed out, what you do when you follow up on a long straddle, which is basically, sell high and buy low, it's very difficult to explain to somebody that the way you manage a short straddle when you are forced to make adjustments and pull the trigger is buy high and sell low. The story of my life. So yeah. It's a little bit tough sell, and to tell them that the reward that you get for that is collecting the time decay, but that is not always sufficient in enough people's minds to wrap their head around the fact that the longer you're getting, you're buying high and the reverse on the downside. So that's not very appealing to a lot of people.
It's not, but, one of the things I teach to, even the intermediate guys and even the beginning guys, I mean, this is how I introduce a lot of people to volatility. The basic people, man, why do I have to analyze volatility? I took some class from, trading school XYZ that had an infomercial at 3 o'clock in the morning, and they didn't tell me I had to look at volatility. Why do I have to look at volatility? All I want to do is income trades and collect time decay. And the answer, of course, is because you know what? When you sell options that are too expensive, your time decay is higher. Your theta is higher. That thing that you're trying to collect, you get more of. And, I just show them, hey, look, okay, so you have two options. Both are on a stock that are trading exactly $50 a share. Both are 50 strike, calls, we'll say, whatever, or puts, I guess we'll say. They're both exactly at the money. They both have the same amount of time until expiration, but one is worth $1 and one is worth $5. And they both expire on the same day. If they're both out of the money at expiration, one will have lost $1, one will have lost $5. The theta on trade B, the one that's $5, has to be 5 times as much, basically. I mean, not exactly. It doesn't work out the math exactly that way, but it's a whole lot more. So Okay, great. You just want to collect theta. You don't want to worry about volatility. Worry about volatility anyway, because you want to get high theta, not low theta.
Mm-hmm. Dan, you made an excellent point there earlier, too. I think it's worth bringing up again. Just the rigmarole and difficulty that is associated with trying to trade pure volatility today, because you're right. Someone can't just say, I want to trade pure volatility. They have to obviously have the knowledge base. I'm assuming someone who comes to you with that question would have the knowledge base to even be aware of that trading style. But then they have to have the capital levels to do it, which is, of course, to truly gamma scalp correctly and accurately. It's a very high capital type of, or I should say, it's a very capital intensive style of trading. And then also you have to have portfolio margining. It's another aspect in there. So there's all these ridiculous hurdles that are in the way of the active retail options trader who wants to trade more like a pro would, with these synthetic straddles and be able to hedge his gamma as he sees fit. And yet we put all these hurdles in front of these people to make it very difficult for them, that gets back to the point we said at the top of the show, too. It will be interesting when these Volex contracts finally come online, because this will be a product people can use to capture realize without all of the other hurdles that have been put in their way for so many years, and they're looking to go after this style of trading.
Yeah, I'm personally really excited about when those products do finally launch, and I know a lot of my students will be too. Don, is there a date on the horizon yet, or?
I wish there were. All I can report to you and to our listeners is that we had extensive talks over the summertime with household names, some of the biggest investment banks in the world, and we have made wonderful progress insofar as partnering is concerned. So everything's headed in the right direction. But as I've stated several times before, dotting the I's and crossing the T's and, making sure that everything's just right and everything's in place to do everything you can to ensure the success of the product from day one is a lot more laborious and time-consuming than I or anybody else at Volex ever would have dreamed. So we're doing everything we can to bring these products out, and I certainly hope that it won't be too much longer.
The joys of new product creation in the options market. It's fun, definitely in quotes. If you enjoy hitting nails and hammers into your head, then you'll find that whole process fun. Well, Dan, I'm glad you could join us today on the Vol Viewpoint segment. And before we wrap up our little chat here, anything else going on at Market Taker Land, or anything you want to let our listeners know about that you think we didn't cover today on the show, or anything else you want to hit before we dive into the listener mailbag?
Oh, no, we've got a lot of exciting things going on. We launched a class, I guess it was a while ago now, but it's become our most popular class at Market Taker. It's our Market Taker Live Advantage group coaching. And it's really great. It's a great place to get trade ideas as well as learn. You get about 20 different trade ideas per class, and there's 2 classes a week. And you can learn more about that at markettaker.com/GC, stands for group coaching.
All right, Dan, thanks for joining us on the interview segment. And actually, I'm happy you're sticking around because you're going to join us also in the old mailbag. So let's get right to it.
Listener mail. Listeners write in.
Mailed in.
Mailbox.
All right, and welcome back to the old mailbag here on Vol Views. It's been a while since we cracked it open, so I'm glad we can get to it and blow some of this dust off, because I know a lot of you have been looking to get your questions on the air. We'll start off with a very, very simple one, a Twitter question coming in from Tomcat1, and he asks, when is Vol Views coming back live? And that's an easy one, Tomcat. You're listening to it right now. So the show is back. We are live again every week, so you no longer have to keep hitting the refresh button in your iTunes player or wherever else you're getting the show, perhaps on Stitcher or on the optionsinsider.com, and keep hitting that refresh button, praying for a new show, because new shows are going to be hitting you every week going forward. So we're back, and we're all very excited to be live yet again. And then next up, we have an email from Ted S. And he writes, actually, this is a trade we talked about on the option block yesterday, too. This is a popular one. He writes, someone bought 20,000 February 70 calls in the VIX yesterday. And yes, Don, you heard that right, Feb 70. He says,
sold for you.
Yeah, exactly. He goes on to say, why do so many people dramatically overestimate the VIX, particularly to the upside? People seem to be ignorant of the historical range of VIX, let alone the typical VIX movement. Perhaps this is more of a comment than a question, but it's been bothering me lately, and I wanted to hear your learned opinions on the matter. P.S. Thanks to Mark, quote, the voice of options Longo, for creating such a great radio network for options traders. Let me address that last part first. I thought that moniker was a little silly, but people seem to like it, and I think it seems to be sticking, so I may have to make my peace with it. We'll see. But thank you for listening to the show here, Ted, and for writing in. And yeah, that is, we talked about it on the option block yesterday, so listeners can go download that. It's going live right now as we speak, episode 180. It was a crazy trade. Someone came in and picked up 20,000 of the February 70 calls. I forgot the price range. Let me look here. I think it was 15 cents, I believe. So yes, just all day long picking up, lifting offers on those calls.
And you know what that guy said right after he made that trade?
Damn.
No, he said, oh, wait, you said 17?
Yeah,
calls?
Exactly. Somewhere right now there's a clerk who just lost his job somewhere. But, that just kind of brings up and puts in stark relief what we've talked about a lot on this show here. And, Dan or Don, feel free to weigh in on this as well. But, just the ignorance of how volatility actually works and how things like the VIX actually work. I mean, for example, this trade here, the Feb 70s, he's picking up the 70 strike. That's about a little shy of 10 handles away from the ultimate all-time high that VIX has ever hit. And that was for essentially a one-day pop up to that level, and it immediately turned around and came back because it was, quite frankly, absurd. And so the fact that someone is putting a substantial amount of money down to bet that VIX is going to hit that level again, regardless of everything else we've always talked about on the show about the foolishness of just buying upside calls willy-nilly and how they're lottery tickets and all the other things that go into that sort of trading, just stepping back from that for a minute and looking at the pure VIX level. VIX cash is trading around 14.5 right now. The VIX futures are hanging in the high teens to the low 20s. It's going to take such a substantial order of magnitude shift in the marketplace to even come close. And even then, that will probably get us up to the high 30s, maybe 40, if we have a very dramatic move. I mean, Don just laid out how the realized vol in the marketplace right now is essentially non-existent. So we really have to have a dramatic shift in that, a supreme black swan event, if you will, to really get us even into the high 30s again, let alone double that to 70. So yeah, this one to me, really, I had to just scratch my head. And Don, I definitely agree. In fact, I took that position yesterday that I would have sold these all day long. I might have been beyond my position limit at the end of the day, but I'm sure I could have found some way to spread this off in a profitable fashion, because this is just insanity.
The point is, you can always talk about people playing the lottery and somebody taking a shot and thinking, post-election, maybe the world's going to come to an end and what have you. But, as you point out, even at times of crashes and even at times of severe market disturbances, you're looking at levels that practically are never reached. And yet, people taking this kind of a shot and throwing out a chunk of cash to try to make a life-altering score, is kind of unusual. I tell this story in our options seminars all the time. I had a colleague when I was at Morgan Stanley who, right before the crash in the summertime, bought so far out of the money OEX puts that, we all joked that they were just virtually worthless, and he paid a teeny or an eighth for these puts and invested 20,000 of his own money to have them. And when the dust settled on October the 19th, 1987, those puts were trading for $50 a contract. 400 times their value.
I'm guessing he turned in his resignation that afternoon.
Well, that's the punchline. So the 20,000 turned into $8 million. And I then say, And Peter doesn't work for Morgan Stanley anymore. But to his great credit, he continued to come in, it's true, at 11 o'clock in the morning and Mondays and Wednesdays only. But anyway, the quick point being that, miracles do happen every once in a while, but it doesn't mean that it's the right way to bet,
Well, and also, you guys are talking about, people doing goofy things that don't make sense, trading uneducated. You're talking about that like it's a bad thing, guys. What's going on here? The more people you got out there doing that, the more opportunity it creates for the rest of us.
Yeah, that's your bread and butter these days. Without those people, where would you be, Dan? But, we talk a lot, and we maybe unfairly bash retail for doing these types of things and buying ridiculous out-of-the-money calls and all these types of things and ignoring volatility. And yet here's someone, an institutional trader with a substantial outlay, $300,000 on what is essentially a scratch-off ticket down at your local 7-Eleven. And that probably is a better odds, I think, even than this trade. So just interesting stuff, and a great question here Ted asked, because it's always fun to pontificate on the insanity that people get up to out here in the marketplace. I'm not sure what's crazier, that 20,000 went up, or that there's 16,000 open to the Feb 65s. I'm assuming that's got to be some hedging going on there. Or 6,000 of the Feb 80s are open, Don. How many of those would you sell for a dime?
Unbelievable. It really is. I mean, it's not to say, we're all looking at this from an expiration viewpoint, and, how could you ever reach 70 then? I don't know what would happen to the price of these things. Possibly nothing, but that's not so sure. If the market were down 10% tomorrow or something like that. So you do have more than one shot at recouping, because you don't have to hold till expiration. But obviously everybody knows my viewpoint on these things, and I don't think most people get rich buying lottery tickets.
This guy should really call you up, Dan, because there's so many better things he could have done. He could have done the 50-70, 1x2. I mean, so many things that have much better payoff potential and a relatively similar premium outlay to what he did. And just, these kind of things always make me scratch my head. Speaking of scratching my head, we have one final question here in the old mailbag before we have to close it up for this week. It's a Twitter question from Sid K. And he writes, this is actually a very timely question given what we're talking about today. He writes, is there such a thing as the gamma of Vega? You just heard Don run through it all at the top of the show about how the realized vol just gapped all over the place. And, the truth is there is no literal gamma of Vega, but we call it vol of vol. We talk about it all the time here on this show. Dan, you're the man who wrote the book on Greeks. What do you want to say here to Mr. Sid K about his gamma of Vega?
Well, yeah, I mean, you know what? There's all kinds of crazy metrics out there, zeta and all these, second order, third order Greeks and all that kind of stuff, and I don't know Sid, I don't know his background. Unless you're a professional and you are able to capitalize on fractions of a cent because you trade 10,000 contracts at a crack, you should probably invest your efforts in worrying about something else. But to that point, I mean, there are guys who need to look at the sensitivity of how Vega changes as the underlying stock changes, which is what you're talking about. And, that is somewhat relevant, but, only if you're trading big.
And it has a name, believe it or not, and it's actually called Vanna, a little like Vanna White, V-A-N-N-A. And as Dan mentioned, you've got these second and third order partial derivatives for the mathematically inclined. And, they've come up with all sorts of weird names that you'd never guess in a million years have anything to do with options, but there's speed and charm and color and Vanna and Vama. That's a repugnant name, V-O-M-M-A. And they all have to do with sensitivity of the Vega to an underlying price change, or to change in actual volatility levels itself, or change in the gamma as the underlying changes, or change in the delta as you move closer to expiration, or change in the gamma. So anybody who's actually interested in these, probably more as a curiosity than anything else, just go look them up online. And probably the best place, and it's well written up, is in Wikipedia if you just search under Greeks. So not the Greeks who live in Greece, but Greeks, and then in parentheses, finance, you will find a write-up of all of these things. And again, for those who are interested, probably more as a curiosity than anything else, there's a good treatment of it there.
I don't know about you, Dan, but I was a big time buyer of Vanna back in the day, but I sold Vama all day long. I couldn't stand to buy that. So there you go, Sid K.
Sounds like a vaudeville act.
Yeah, it does. I can't wrap my head around those names. Those are terrible. Vanna. I can't take seriously anything with the name of Vanna because I just think of clapping as the wheel of fortune rolls around, and it's terrible. But there you go, Sid K. Great question. Thank you to everyone who wrote in this week for the old mailbag. If you'd like to be featured like Sid or Tomcat or Ted or anybody else on the show, then by all means surf on over to theoptionsinsider.com. You can post in our forum. You can write to us via Twitter, twitter.com/options, or on Facebook at Facebook/optionsinsider. But with that, we're going to close up the mailbag for this week and dive right into our crystal ball segment.
And now we take a look at the crystal ball.
All right, and that haunting tune, I mean, we're getting close to the end of the show, but we have one more segment. That is, of course, our crystal ball, where we dive into the murky ether of volatility and attempt to divine what the future holds in store for us. And we hit on it a bit at the top of the show. Of course, we're looking at realized vol levels that are essentially bordering on non-existent. And so with that in mind, I think I have a feeling about what you're going to say here, Don, but maybe you'll surprise me.
No, I'm afraid I can't. I can't look at 9 on the S&P or 10.8 on NASDAQ and say that it looks like these numbers ought to come down, because that just doesn't make a whole lot of sense. Of course, if this market has got somewhere further to run to the upside, it really could be a while until we see the increase. But any type of attempt to use any of the standard GARCH or modified GARCH forecasting models of future volatility from our friends over at the Volatility Institute at NYU and Professor Robert Engel, all the numbers, as you can imagine, are substantially higher. Predictions for 1 month forward NASDAQ realized volatility, 17.5, 19.6 for 3 months, 24 for yearly volatility. And of course, those are big numbers, but they're historical norms. So basically, the old reversion to the mean, and the S&P numbers are lower, but they're still certainly higher than the levels we have now, with 13.6 for 1 month and 14.4 for 3 and 16 for the coming year. So, again, wish we could have recommended a trade on the narrowing of implieds with respect to realize a couple of days ago. We missed the boat by a couple of days.
Dan, you want to throw your hat into the NASDAQ or VIX prediction game before you go here?
Oh, boy. Setting up for being wrong on this one, aren't I?
We say, Dan, all you can be is wrong.
That's right. I'm just going to talk in somewhat qualitative terms, and I'm going to say, you know what? I think it's going to be. I think it's going to be high. Maybe not sky high, but I bet it's going to be between 17 and 20 for the fall. The VIX.
So what you're telling us is that really you were the one behind that 20,000 lot of Feb 70s. That was you.
Who told you that?
I saw that trade go up. I said, this has Passarelli written all over it. All right. Well, thank you for that. And that is going to do it for our crystal ball segment. That's also going to do it for this episode of Volatility Views. It is indeed great to be back, isn't it, Don?
Yes, I enjoyed and look forward to the upcoming fall shows, and well into the new year. I'm happy to be back, and I hope our listeners enjoyed.
And Don, before we go, as we are wont to do, we hit on a little bit before in the Vol Viewpoint segment, actually, about what's coming up at Volex. But anything else going on at volex.us you want to let our listeners know about?
Well, as we work feverishly to bring the products out, we also want people to be aware that there's a tremendous amount of research and analytical tools on the website, and we literally do work on this every single day to just make it as informative as possible. I'm telling the absolute truth when I say that if I've got a spare half hour here or some spare time, I go into the Volatility Library. I take a look at a couple of papers to read. I honestly believe that the Volatility Library at volex.us may very well be the greatest concentration of scholarly articles and information about volatility that can be found on any one particular website on the internet. So we're really proud of that, along with the tremendous amount of analytical tools in terms of charting and historical information. So listeners, if you haven't had a look around, go over to volex.us and spend a little time there. I think you'll enjoy.
Dan, I know you guys have done a lot of work on the Market Taker website, but one of the things that might interest you that the Volex guys actually have going on, they're big proponents over there, I'm not sure if you know this, of the old volatility cones. In fact, Bob and Don they love all those tasty flavors of vol cones. So it might be something interesting for you. I'm not sure if you use those very much when you're guiding your students through their various levels of premium selling. But when they're looking maybe to blast out puts on the bid in Apple or something like that, maybe it might be fun to walk them through a vol cone and show them, hey, here's where the level is that you're actually selling. Here's where historical vol has been. Here's the highs and lows. And I'm sure Don will be happy to send you some examples on that front, because they are big proponents of the vol cones over there.
Yeah, I'd absolutely love to see them, Don. It sounds great.
Just go over to the site, and in the pull down menu, you basically find all this data. And the fact of the matter is that I think that anybody who does any kind of an options trade that involves a level of volatility should kind of be aware of where you stand with respect to historical norms. And if you're selling vol and 90% of the time it's higher than it is right now, that's a red flag, and that's a caution. Maybe you ought to think about what you're doing, and vice versa, of course. So it's an analytical tool like any other, but it's kind of a good one to have in your arsenal before you put on a trade.
All right. Thank you for that, Don. And Dan, thank you for joining us. And listeners out there, we all want to thank you for joining us as well. And before we go, I just want to mention, hopefully by the time you're listening to this show on Monday, if you're surfing on over to theoptionsinsider.com, you'll find some interesting new features and functionality over there, including some interesting new radio functionality. And there will be more to come in the coming weeks and months as we go through a major upgrade of our back end over there at theoptionsinsider.com. So if you haven't surfed over there in a while, then I encourage you to check it out. If you're surfing there on a regular basis and you see that it looks a little bit different on Monday, now you'll know why. We've done a little bit of work under the hood, and it should be even more interesting and be able to get you more of the content you love faster and easier than ever before. But of course, that's going to do it for this episode of Volatility Views. My name again was Mark Longo from theoptionsinsider.com and the Options Insider Radio Network, and we'll see you next week right here on Volatility Views.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about vol contracts, please visit www.volex.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volx_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the Volex Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.